It's the end of an era. The hair has been cut, and because I no longer have the long hair, I have lost all ability to do any sort of quantitative finance. I no longer can do any sort of Markovian analysis. I can no longer do my stochastic calculus. And of course, that means that I've been suffering on all of my exams as of late. But all jokes aside, in this video, what I really want to do is I want to talk about the current landscape, the current macro environment, the current market environment, and discuss some interesting trends, discuss some interesting news to look out for next week and the following week, and really just make a nice little summary of the current market climate and kind of talk about what my strategy is going forward, at least in my own portfolio. Now, this is not investment advice, okay? I have absolutely no interest in giving formal investment advice to all of you right now. What that means is I don't want to hear about your naked call options that you bought after watching this video that have lost all value. I really cannot stress that enough. This is not a video giving you any form of investment advice. In the comments below, if you would like to comment your views, or if you would like to speculate, or if you would like to engage in some discourse about my views, please do. I do encourage that. You can also join Discord where we can have a more formal conversation. But yeah, let's go ahead and get into it. What is going on right now in the economy? What's going on right now in the markets? Well, to nobody's surprise, the S&P 500 has been cooking recently. We saw all-time highs not only in the S&P 500, but also with NVIDIA's market cap going over $1 trillion. So let's just look at NVIDIA for a second. $2.06 trillion. And if we look at year to date, that is some ridiculous growth. Stock price practically doubling within this roughly 2-month period. This is just leading the charge for the S&P 500, right? If we take a look at the S&P 500, let's go to bar chart. Look at the full chart here. We could see an all-time high. How about that? We are at an all-time high in the market. So what does that mean? Well, let's take a look at the current sector map. Let's take a look at the year-to-date sector map. We could see tech spearheading this. Of course, that's not a surprise. We saw NVIDIA. We see all of these technology stocks that are kind of riding this wave, the semiconductors like NVIDIA. We see Rambus. We see Taiwan Semiconductor. All of these AI companies, everybody is super hyped up on. A lot of people are even kind of trying to compare this to the dot-com bubble of 1999, 2000, 2001. But the big difference between that bubble and this current landscape is they're cash rich. Those dot-com companies IPO'd and were burning cash. They had absolutely no earnings to show for it. But if you take a look at any of these companies, valuations are very strong. Moreover, we don't see stagnant growth in any of these sectors, right? Poor utilities and real estate down here for sure. Commercial, I believe, is what's driving real estate down significantly. But over that, we can see everything from staples, discretionary, industrials. We see growth everywhere, right? It's important to realize the S&P 500 is a market cap weighted index as well. So we see a year-to-date growth of 7.7% already. That is cooking, right? On average, it's 10% year over year. But if we take a look at the equal weighted index, right, the SPW here, we see that it is 3.61%. So there's still growth, but not as much. And of course, that's due to the lack of weight in those companies that are essentially leading the charge in growth for the S&P 500 here. All right. So we see this growth in the equity market, but what about employment? What about the underlying economics that's driving this growth? Well, in January, we saw non-farms at 353,000, smashing analyst estimations. We saw unemployment remain at roughly 3.7%. And if we take a look at unemployment over the years, I definitely have this chart. Here it is. We can see that it's the lowest, so it's remained under 4% for, I think this is the longest time since the 60s, since like Vietnam. For, I think the past 2 years, it's been under 4%. And I didn't read that. I heard that on Bloomberg Daybreak. So, that is an interesting fact that you can take a look at in this chart here. We had egregious unemployment during the COVID-19 pandemic, and now we're hovering around this pretty steady 3.5%. But of course, all of this growth is not without inflation, right? Inflation is kind of the big bad wolf that we all have to be on the lookout for here. And during essentially, we'll talk a little bit more about the consequence of inflation and the growth. But let's continue on this employment and job sort of situation here. So we're going to get more. So this is non-farms, right? This is non-farm payrolls, is the jobs added in January. This could suffer from a degree of seasonality, right? So we could expect this to normalize in February. I believe current estimates are at 180,000-ish, give or take 20,000 in either direction. We're actually going to get solid numbers on February's non-farms and unemployment on March 8th next week, so do be on the lookout for that. The following week, we're going to get more inflation for February. We're going to get CPI and PCE. We're going to talk about that in a minute. But next week, not only are we getting non-farms and unemployment, but we're also going to see Mr. Powell discuss monetary policy at Congress. So this isn't going to be him raising or lowering rates or anything like that, but it's going to be one of those situations where we're gaining information in our information set, and it's going to be priced into the market, so we have to follow closely to see if he has any wisdom to share with all of us. So let's go ahead and pivot now and talk a little bit about inflation, right? And then we're going to talk about the contractionary and the expansionary cycles that we've seen over the past couple decades, and kind of talk about where we are right now. So let's kind of talk about the current inflation landscape. So if we look at core inflation, that's excluding food and energy. For PCE, we have 2.8%. Core inflation for CPI is going to be 3.9%. Okay, what's the difference between CPI and PCE? CPI is a survey. PCE is based on essentially consumer purchase data. So it's based on data. That's the preferred gauge, right? You want to use the data rather than what people say is the case. Nevertheless, we look at both of them here. We also have the headline numbers for CPI at 3.1%, the headline numbers for PCE at 2.4%. Focusing in on this PCE number here, we can see that we're kind of closing in on the Fed's 2% target to some capacity, right? If we look at the core PCE here, they've made comments in the past that they don't necessarily need to see inflation get to that 2% to be willing to cut rates. But, right now there's really no reason to cut rates. We're not seeing any sort of cool down. We just discussed in the context of the S&P 500, the market and each of the sectors, it's hard to lobby for rate cuts right now. Unless you're, of course, these companies. It's very hard to lobby from an economic perspective, why we should cut rates right now. Interestingly enough, if we were to kind of shift our focus to the yield curve, we do have an inverted yield curve, and this guy has been with us since late 2022, early 2023. And what that means is short-term rates are higher than long-term rates, right? Typically, it's the other way around. Typically, you would expect the yield on a 30-year treasury to be arbitrarily higher than the yield on a short-term treasury, and that's because you have more risk, right? If you hold that long-term bond, rates could go up, rates could go down, inflation could go up, inflation could go down, et cetera, et cetera. You have all these risks, right, associated with the price of that bond that you're holding. But of course, right now we have an inverted curve. We have the federal funds rate at roughly 5.3%, I believe. And that overnight lending rate has pushed up these short-term rates to, I believe we have the 1 month at like 5.4%-ish, 5.5%-ish, 5.5-ish%, right? And I believe year to date it's up roughly 40 bips, but I'm not going to double check that right now. But we've had this inverted yield curve, and typically people are going to say, oh, the inverted yield curve, that's a signal for recession. I want to kind of extract and remove the causality from what an inverted yield curve is. An inverted yield curve is endogenous to this space, essentially, of a contractionary or expansionary economy, right? Or contractionary and expansionary policy subsequent of the economy, I should say. And what I mean by that is, let's go ahead and check out this really cool dynamic chart, all right? On the left, we have the yield curve, which is exactly what we just looked at, and on the right, we have the S&P 500. So let's go on back to 2000, right? This is around the dot-com boom and the dot-com bust, right? Yield curve is in transition here, right? So it's flat, and we kind of go over here. We see it's kind of normal there. It's got this concavity to it, right? It's normal, and then boom, these tech companies are cash poor and they're going bankrupt. The yield curve inverts, and then the Fed cuts rates, and now rates are super low, and we're trying to dig ourselves, or essentially climb out of this this kind of moat that we found ourselves in consequent to that bubble, right? So low rates, this is a normal looking yield curve. The cost of money is cheaper relative to here, right? Relative to earlier in that year 2000. Hopefully stimulating growth, encouraging companies to spend. And we see that here, right? We see this period of growth, and we see this flattening of the yield curve. And then once again, 2007, 2008, we get an inverted yield curve. And then we see this decline. Fed cuts rates, Fed cuts rates, Fed cuts rates. And then same story. We see this growth. Rates remain almost zero. Almost zero. The Fed hasn't looked to raise rates during this time at all. Why didn't the Fed raise the rate at all here? Well, this is a story of inflation. If we take a look at inflation, let's go to the inflation chart. I know it's somewhere here. Inflation. There it is. Right? Take a look at the inflation rate, right? The inflation rate has been entirely reasonable coming out of that. We had, this negative inflation, right? Some deflation here, some disinflation, deflation, and now we have this inflation again. And inflation stayed relatively stable for this entire span, this entire almost 10 to 20 some odd years. And because of that, rates were so low. I mean, I remember, roughly 10 years ago seeing memes about what I really could use right now for my my fixed income, my mortgage, whatever, is some 8%, some healthy 8% inflation, right? Like we saw rates so arbitrarily low for so long, and then of course as we started to approach 2018, 2019, 2020, we saw rates start to increase again, right? And we start to see a little trend here, 2018, 2019, inflation starting to, it's still normalizing, but really the big kind of like jump from this steady, stable period of inflation and zero rates was, of course, during 2022. Now, we did have COVID in the meanwhile, right? The Fed was able to raise rates, and of course, as we experienced COVID, once again, cut rates, right? That was essentially what had happened here. We saw towards, and this was almost a 20-year period. This was like, look at how arbitrarily low rates were, right? And then the Fed was able to raise rates around, looks like 17, 18, 19, and that gave the Fed a little bit of wiggle room so that when COVID came, they were able to cut rates again. We saw this sort of shock to growth, and then the Fed was able to cut rates to help stimulate more growth. So that's where we continued here. And this next cycle of growth, so this is kind of what's important to keep in mind is, all of these cycles here, in conjunction with the Fed raising and cutting rates, are based on not only the current health of the economy, the equity market, but also taking into consideration inflation, right? So if we take a look at the incredible rise, the meteoric rise of inflation in 2021 to 2022, we can see the Fed raised rates an incredible amount, right? So it went from near zero rates to roughly 2, and then 4, and then now hovering around kind of 5-ish% here. And that brings us to current. So this is where we saw the inverted yield curve in modern times for the first time, and that was coming sort of out of 2022 into 2023, and now we're sitting here with an inverted yield curve. What is the difference between this inverted yield curve and the inverted yield curve that we see here earlier before the financial crisis, and this somewhat inverted yield curve we see here before that dot-com bubble? Well, let's take a look at inflation, right? The difference here is, I don't even think this goes back to 2001, but if we take a look at the financial crisis here, inflation was relatively steady, right? If we take a look here, inflation is relatively steady. We're trying to close in on the 2% target to see if we can cut rates in general. But the overall health of the economy, right? If we take a look at the market heat map again, it's in a great place, right? Nobody, and this is of course like this is what finance is. This is what the market is. This is what macro analysis is. It's, we look at these trends and we take a look and see what catalysts could exist to, shock the market into a tremendous recession, or not. And there have been studies done that people tend to be, overestimating the possibility of a recession, right? Imagine, if I asked you a year ago, 2 years ago, is there going to be a recession in 2022? Is there going to be a recession in 2023? Is there going to be a recession in 2024? If you went short the market in 2022, good luck. You would have gotten killed. Definitely would have gotten limited out of your position for sure. But that's kind of my point here is, everybody is a genius in a bull market, and I'm also able to say that hedge funds generally have a harder time finding alpha when everything's going up altogether. But one thing to keep in mind here is the big difference between 01 and this current situation is these tech companies are cash rich. They're definitely not IPOing and then burning cash, going on vacation. They are, this shows up in their valuation, right? This is something that we see right now. But of course, there are situations like, 2007, 2008. This was, of course, a heavy period of regulatory action was taken post the 07, 08, 09 sort of financial crisis here. And then, of course, COVID was the great catalyst for this kind of brief drawdown here. The real question is, what's going on right now, and what are the main drivers of growth? And what can we see in the not-so-distant future that could be kind of inhibiting this growth? And for me, it's very difficult to see. And I think, of course, hindsight's 20/20. But I would speculate that the economy is in tremendous health because look at this beautiful tool the Fed has available in their toolbox. That is, they have the ability to cut rates a significant amount, right? Inflation is already pretty arbitrarily low, and I don't think some inflation is bad necessarily, right? If you ask any homeowner, is inflation, arbitrarily bad, though it does take time for wages to catch up, I'm sure, they would prefer some degree of inflation because it makes paying their mortgages easier. Whether or not they actually feel that effect is conjecture, of course, but nevertheless, we're sitting in a pretty reasonable economic environment to where growth seems real. Growth seems real across all of these sectors year to date, right? Not only that, but we also seem to have a reasonable macroeconomic environment in the sense that inflation isn't out of control. According to the PCE, core PCE, it's closing in on target. Headline PCE closing on target even closer. CPI, it's a kind of a toss-up. It's a little bit different, but a little almost more than double. But nevertheless, it's always going to run a little bit cooler. PCE is going to run a little bit cooler than CPI. Nevertheless, all this is to say, I think the economy is in tremendous health, and you're going to start to see some interesting plays, right? So what I mean by that is, if you have a long portfolio, let's say that you're saving for retirement, what is a good sort of aggregate weighting for these different types of securities? Well, if you're 60% in equities, let's say you have a reasonably diversified equity portfolio, maybe you just buy the market portfolio, which I would entirely encourage anyone to do because, the market, if you're not doing it as a full-time job, you're not speculating, you're not doing your research, then, I'm very hard pressed to say no to an average 10% year over year return. So let's say you have a market portfolio and 60% of your portfolio, you have bonds and 40% of your other portfolio, or the same portfolio. You have 60% weight in equity, 40% weight in bonds. What is the outcome that we're looking for here? Well, I think we're in a heavily bullish market, right? And the reason I think that is because of the year-to-date performance of the S&P 500 right now. Moreover, we saw strong job growth in January. It could be seasonal. We saw low unemployment. We're going to get more numbers this week. Mr. Powell is going to speak. And then, of course, the following week, we're going to get inflation. That's going to shed even more light on the situation. But to speculate right now, I think that this is a great opportunity to have kind of short to midterm bonds in your portfolio, along with your market portfolio, whatever that may be. Maybe you buy a tracking ETF, maybe you diversify on your own and then rebalance. It's completely up to you how you structure a portfolio. But what that's going to enable you to do is essentially you're going to have this rise. And of course, there's going to be some variability in the yield to maturity for the bonds in your portfolio over time. But overwhelmingly, what I'm suggesting is, if the economy does cool down and you see some retrace in the equity side of your portfolio, the Fed has the ability to cut rates. And when the Fed cuts rates, that bond prices increase, short-term bond prices increase, all else equal, of course. And that can be used to kind of offset those equity losses until the growth continues, kind of those shocks to the growth that'll offset. I believe that's the so-called Fed put that I've heard on a podcast recently, but I think that is a reasonable assumption. I think we're also going to see more roll down plays in the yield curve as we see more rate cuts. So you're going to see more, 2 years, buy a 2-year, and then sell it at, say, like a 1 year or a 6 month, because obviously if this yield curve normalizes, then you're going to be able to collect that difference. Should you buy at a higher yield to maturity, you can sell it at a lower yield to maturity for a higher price. So those bond plays we could see coming back as well. But yeah, that's going to do it for my current view of the macroeconomic landscape, the market landscape. I think we're in tremendous health as of right now. And of course, I'm saying this now, there could be some tremendously negative catalysts to occur. But if you look internationally, I think growth has kind of stagnated elsewhere. You look at China, you look at even Japan. I think there's an increasing attention on the U.S. and GDP was looking good. I think Q4 2023 we saw 3.2%. And yeah, I mean the next numbers we have to look out for are GDP March 28th. We got Powell talking next week. We got non-farms unemployment next week. We got inflation on the 12th. And yeah, those are some important indicators to look out for. And maybe I'll make more of these types of videos in the future if you guys enjoy them. So thank you so much for watching. I hope you enjoyed the break from our stochastic processes discussion from the previous video. And yeah, I'll see you in the next one.